right, so quick housekeeping session will be recorded. Here are some disclaimers for you. So why do we do these fundraising workshops? This is a quick overview about SVB. If you haven't heard about us before, we've been around for over 40 plus years, serving the innovation economy as a banking partner, as well as an ecosystem partner. SVB sits between founders and VCs, so we like to create a marketplace where we can help early stage founders connect with amazing investors like Alexa and introduce them to our larger ecosystem of other experts, operators, as well as investors. We are now a part of First Division, a bank which has been around for 125 years, and we have access to the strength and stability of their balance sheet, which is about 200 billion AUM. So if this will proceed, oops. A little bit about myself. I think this is probably like the 50th fundraising workshop I've done. As I was looking at all my other slides, I was like, wow, this started since 2021. A huge reason why I love the work that I do here is because I actually started out as an SVB client back in 2011 at Sunrun Inc., which is a renewable solar energy startup, and really tasted the startup world, wanted to get deeper more into the technical operating side, so taught myself to code to become a product manager at places like Meta, Instagram, as well as Tumblr, and then moved over to the VC side in corporate venture at Samsung Next, investing in AI, edge computing, and data privacy companies. So now my role here is working with an amazing team of startup bankers who really think about how do we catalyze the future founders of today so that they can start as early as possible from an idea on a napkin sketch all the way to Series A and beyond. So we also bring amazing speakers like Alexa Tobel to join our fundraising workshop, because even though we have a lot of great state-of-the-market data, we realize that the tactical know-how of fundraising comes best from a primary source like Alexa, who has invested in hundreds of founders. And also, I think you're a rare breed of VC where you come from the operating side. So you have the empathy of building in the trenches. So a quick introduction about Alexa Tobel is she's the founder and managing partner at Inspired Capital. She founded LearnVest in 2008 with the goal of helping people make progress on their money. After raising nearly $75 million in venture capital and selling LearnVest to Northwestern Mutual in May 2015, Alexa started Inspired Capital, Penny Pritzker. She's also a multi-potential like Renaissance woman. She's a New York Times best-selling author of a book called Financially Fearless and Financially Forward, which is amazing because financial literacy is a huge passion of mine. And she's also the host of the podcast Founders Project with Alexa Tobel, a weekly podcast with Inc. So welcome, Alexa.
Thank you. First of all, so happy to be here, everybody. And I remember what it's like to be all of you guys trying to build businesses, and it's so hard. And so I'm really excited for the conversation today.
Great. So the format of these fundraising workshops is, yes, we do have slides, and we open it up with state of the market, what's the temperature check in the macroeconomic landscape, but the real learning comes from the dialogue that happens between the two of us, as well as with the larger audience. So feel free to interject with questions for folks who are tuning online. We do have a Q&A box for Michaela to help us moderate. So think of this as more of a Socratic method. We don't have to get through all the slides. Some of the data is relevant, some may not. So please, choose wisely in terms of like what you take as advice and what you take as, just general guidance. So let's talk more about Inspired and kind of set the stage for how founders, can work with you as a venture fund in early stage investing.
Sure. So first, I've been a New York City tech entrepreneur now for almost 20 years. I was Harvard undergrad, helped build a company right out of school that got acquired by Facebook. Mark was my classmate. I went back to Harvard Business School, dropped out in the fall of 2008, built one of the first fintech companies, a software company for financial planning called LearnVest that got acquired for about $400 million with Northwestern Mutual. Punchline, why inspired? Through that journey, I kept thinking like, where's the capital that I want to work with? As a competitive, deeply entrepreneurial human, I dropped out of college to start companies. My mom's like, please God, just graduate one time. And Punchline Inspired is an early stage fund. So we're a generalist fund. We go now into Series A. We now manage almost $1 billion. Each fund is approximately $330 to $350 million. And why does any of that matter? We are very long duration capital. So we back companies with big ideas, and we try to stay committed for truly 15 to 20 years. Our capital behind us is very patient. We're then different for three specific reasons. The first is our founding team has built 10 companies, so it's very different. We sat in your shoes. It's almost like giving parenting advice if you've never had a child, like that would just be silly. And so we're capable of helping our founders kind of get through the rough times because we've lived them. Final two reasons are the entire team. When we back a company, you get the whole team. So it's pretty unique in the way we operate. It's not one partner. You actually literally get the entire team of Inspired behind you, and we've worked together for almost 80 years of overlapping. And then finally, as you mentioned, Penny Pritzker is one of our co-founders, former U.S. Secretary of Commerce on the board of Microsoft, chairwoman of Harvard. And as a punchline, you say we can be really helpful with introductions in ways that can help set our companies apart. So that's us.
Great. So let's get started. To kind of set the scene, this entire workshop is really to help you walk away with 3 clarified whys of like, why you, why now, and why the problem that you're solving. So just think of this as like a through line in terms of all the slides that follow. Quick disclaimer, this fundraising is a fairly bespoke sport. This is not one size fits all approach. A lot of the data here, we try to stay relevant with the latest market data, but we, may have some coverage that is biased more towards the East Coast and the West Coast market. So if you are fundraising, in a different market, please tailor that to your own situation here. So one way to kind of contextualize the market is, we think it's important for founders to really think about what kind of market they're walking into. So we're in a very high interest rate market right now since 2012. Obviously, the Fed made a rate cut back last Thursday, and that 25 bips is making the public markets feel pretty good. We also expect 2 more rate cuts, but we're still in a fairly high interest rate environment, which has created more conservative cost cutting and spending for a lot of companies. And we've seen that, beyond just COVID-19, but also as the public markets, have kind of struggled in a high interest rate environment, it makes a lot of the venture as an asset class less appetizing to LPs. So these founders are also thinking about ways to stretch their runway, which is what we're seeing in the second graph around cost cutting. As a result of cost cutting, it's also affected a lot of the IPO market too. If you think about the way that the public market drives the private market, we have less companies that are ready to IPO in terms of their revenue multiples. So at the peak of the market in 2021, unicorns were growing by about 68%. Today, that has dwindled to about 18%. So this is just kind of giving you a quick temperature check in terms of like where public and private markets are going. To kind of make this more relevant, as of last week, we obviously got a new president, a new administration, and a lot of the investors, especially on the private market, feel kind of jitterish during election season. The good news is the S&P 500 is not really correlated with election cycles. So we have here to the left, a graph of median annualized volatility of the S&P 500 mapped across the average annualized volatility. And if you look at the zero and the x-axis, that's usually the election day. So we see volatility happening before and after, but it tends to kind of peter out as time goes. The other table here, which is essentially presenting the same information, but in terms of market gains, depending on who wins and loses which party, we also don't see that much significant volatility either. On average, depending on which party wins, you know, the S&P 500 tends to be favorable 76% of the time, and it was projected for the market this year to be about 15% in gains at the election, and it ended up being 18%. So regardless of policies and, you know, media cycle, it does take some time for everything to trickle down to the market, and the market tends to be focused on the fundamentals. So just wanted to give you guys some optimism in terms of, you know, whichever outcome you were rooting for, that the larger S&P 500 is fairly stable. So speaking of election cycles, I think it's important for us to also touch upon what is the relationship between public markets and private markets. Obviously, this is correlation, not causation. So we recognize that, you know, the public markets lead private markets, but also private markets may have some of their own, you know, specific variables at play. But I think what's interesting about this graph is the correlation between the public and private venture, you know, asset class is fairly correlated from a 12-month lag perspective. So since the 2000s, we're seeing public and private markets strongly correlated over time. And we do hope that as interest rates fall this coming year and public markets open up again, that we're going to see a stronger return in private investments as a venture asset class. And then in terms of like how all this snowballs into the IPO market, I think it's interesting for us to think about the IPO market as like, this is kind of what sets the tone oftentimes for the private market to follow. We've been seeing a healthy, you know, number of IPOs. Obviously in 2021, that was the best year ever, but we consider that to be an anomaly. Election years tend to have fairly strong IPOs too. So you see in 2022, 2026, and 2020, there were still a healthy number of IPOs. But since 2022 and onwards, you know, the IPO opportunities are kind of in the single digits. And part of that is reflected also, we mentioned cost cutting, is the revenue multiples are not as robust as they used to be. So for the street to value company that is going public, they're looking at, you know, is this going to be a 20x revenue multiple? At the peak of 2021, it was almost 17x. Now it's fallen to about, you know, 11x. So a lot of these unicorns are actually sitting on cash. You know, the top quartile unicorns has about 5 years of runway, and then the median unicorn has about 20 months. So there's a lot of waiting for the public market to recover before the IPO market opens up, and companies are going to want to go public, which then creates liquidity down the line, which trickles to the private market. I'm curious in terms of the inspired outlook, how are you guys advising founders to think about, you know, we're in a high interest rate environment, LPs are a little skittish, you know, some funds are open for business, others are kind of quiet. Like, what is your kind of temperature check right now for your founders?
So in general, we tell our founders a few things, which is at the end of the day, if you're really a founder that is doing something that really matters, you should be taking a 10 to 15 year view on what you're trying to do. I would say the best founders really live in the future. You're living 10, 15 years out. You're thinking about all the ways technology are going to change your business, or your business is going to change technology. And for the most part, all of these graphs don't matter that much. I always say the best founder sleep is one eye open towards them, where you have a sense of what's happening, especially when you begin to get, you know, closer and closer to needing new capital. The way I think about those moments is in your life as a CEO, as a founder, you're gonna probably have anywhere from 5 to 8 major financial moments that really matter and change the course of the company. And those are when you raise your pre-seed and your seed, and then your A, and then your B, and then in your seed D, and you go public. Or, if you're more capital efficient, your seed, your A, your B, your D, you go public. And so in general, we advise our founders that you need to be more cognizant of these dynamics when you're going out for one of those moments and you're going to need some cash. But otherwise, the reason you care about these graphs is, are people buying your product? And when market sentiment, if it's consumer is cautious, then that matters. If you have a B2B software company and CFOs are cutting costs left, right, and center and laying people off left, right, and center, guess what? They're probably not left, right, and center buying more product, or in sort of the discover zone where they're willing to try things, unless what you're doing really matters. So you care about these because it impacts your customers. And you care about these for when you're going to go raise capital. And ideally, you're a great CEO, you're steering your boat to avoid needing capital, but those graphs are all at the bottom, right? If you know we're in a recession in, let's say, next year, you don't really want to be in a position where you have to go raise cash next year. You want to rechart your boat, cut some costs, buy yourself another year or two so you don't have to do that, or convince an insider to step up and help you out. But in general, that's how we think about it. And I think what really matters is not getting too distracted on these things, but asking yourself every day, am I building a product that really matters? And am I doing something that's dramatically, you all know, I'm sure, the book, The Purple Cow, it's 20 years ago, it's a great book, but it basically says, if you see a purple cow, Seth Godin's the author, you'll tell everyone no. If you see brown cows, you're not running around telling everyone you know about the brown cow. But if you see a purple cow, you're gonna be like, holy smokes, I saw a purple cow today. And your customers are gonna tell everybody. And so if what you're doing isn't a purple cow, that's what you should be focusing your North Star on, because you're never gonna build the business that you're really excited to build. If the product doesn't delight customers, do something materially better, dramatically change technology or the future in some very powerful way. And asking yourself the question, am I really innovating? Am I truly innovating, or are these tiny tweaks on the thing before, and it's incrementalism versus true innovation? So those are the North Stars I want you guys to focus on.
I guess we should start calling unicorns purple cows. We're gonna have to start adopting that and give our founders as mandatory reading. So last market slide before we dive into the more important stuff, which is the tactical things. We want to share with you guys kind of the strength of the seed round compared to later stage. Seed, a lot of you guys, on a show of hands, how many are currently raising a seed right now? Okay. Or already raised. Congrats. Great. Congratulations. Okay. So maybe you'll be raising a C plus or a Series A soon. So this slide I think is important to kind of talk about how the later stages, Series A, B, and C since 2021 have been a lot more volatile, but we're still seeing, the green bars for seed, the median round size to continuously go up from 2.25 all the way up to 3 million. And I think part of that is also because of this third variable effect where like Series A's are taking longer to raise. So we're seeing chunkier seed and seed extensions inside rounds. But I think overall the takeaway here is if you look at the delta, which is in the lower graphs of the difference between 2021 and 2024, seed is far more resilient than the later stage. So we see seed valuations and round deal size still hold steady. So it's a great time, to be fundraising, to be a seed stage company. I think if you were gunning for Series A, B, or C, that might be a little bit more challenging. And then in terms of where we see the kind of Series A crunch that's happening more is for the number of seed deals that are getting done versus Series A. There's a pretty sharp, drop off for Series A. In about 2017, there was about 2-to-1 seed to Series A deal. Now in 2024, it's about 3-to-1. And the time it's takes to raise a Series A. The red line here shows that, it's taking longer. So the number of Series A companies that raised in the last 6 months has been falling, and how that kind of translates into a fundraising process is almost like an evergreen, fundraising process. As you finish your seed, start thinking about the next round and then the round after that. I'm curious, out of the portfolio companies and Inspired, like, how are you advising founders to kind of think about this, Series A crunch and to kind of prepare themselves?
Yeah, I have this concept, ABS, always be selling. You quite literally, as CEO, you can take one day off from fundraising, and it's the day the money wires. And then you go to sleep and then you start again, and the next day you need to be thinking about it. We tell our founders to leave your data room open, leave it completely set. It's like hygiene, it's like brushing your teeth. You should constantly be updating your data room with latest documents, things that people would need, an amazing sales deck that you made for something else, put it in your data room, so that it's always there, so that you're never flat-footed if somebody inbounds you or if you decide to have a few conversations. But in general, you are always making sure that you are thinking about capital. And that does not mean you're fundraising every day. I want to be very clear, but your job is to always make sure that you have a sense of who are the people that you want to talk to next. Are you staying in touch with them for coffees? Some people say never, ever chat with anybody in between rounds. That's not us. I think we're very long-term capital partners, and we marry people when we commit to them. We really commit. We're not fair weather investors. And so as a result, I think making sure that you're building real relationships with people is going to set you up for success. It's important to say I'm not fundraising today. Like, I'm here to just get to know you and make sure we build a great relationship. But I do think that you are constantly, and then, to be clear, those are fundraising meetings. Those aren't coffee chats. Those investors are scrutinizing you, you're scrutinizing them. It is very much a fundraising meeting. But I think the markets can change on a dime. Right? We went through COVID on a dime. You never know if 9/11 can happen. Your job is always to be protecting the company from downsides and making sure that you constantly have warm leads of people who potentially could be interested in your next dollar of capital if you need it.
So speaking of kind of
Obviously subscribe to like the best founders with the most paranoid human beings on the planet.
only the paranoid survive.
Quite literally, I'm always like, I know where all the exits in this building already are. No, I think your best entrepreneurs have a plan A, B, C, D, and E at all times. Like, you know what you're gonna need to do to stay thriving.
I love that, contingency planning at all time. Speaking of kind of always be selling and taking these meetings, even when you're not fundraising, what is a good way to position yourself as a founder? Just getting to know investors, maybe gearing up for that next round without having to show them the data room and the pitch deck, which is not ready yet.
I mean, I think some of the most thoughtful founders put together like a one-page memo on what they're doing and why it matters, and share it with the internet and like put their strategy out there. I mean, I'll take me way back in the day. There was no Twitter and things like that. I was building LearnPath, and it was financial literacy for the masses. And so I would literally put out decks. I did a TED talk on like one life-changing piece of information you can give every college graduate. Get your content out there, get your strategy out there. If it's like your secret sauce, and we're talking about like literally the 3 ingredients that make you different, don't get that out there. Like, that's your secret sauce. You protect that until you're big enough you don't have to protect it. But I think that you should constantly make sure that investors know what you're doing. And I'm sitting here, I've invested in consumer companies, climate companies, but fintech is really my life's work. I read what other people are putting out there in fintech because I want to know, I want to be paying attention. And so it's a great way, you're staying in touch with investors that you don't even know are paying attention to what you're writing. And so I'm trying to be clear, when we think about like getting to know investors, that's not just because you met one-on-one for coffee. You can get to know investors leveraging the incredible internet that we have and all the content and materials you can put out there. And I do think we always look for the founders that have an N of 1 point of view. They have a very, very, very differentiated point of view on what is going to happen and why. And it's a deserved point of view. And I'll learn that as an analogy. I started a company that was like, I believe that financial planning shouldn't be a luxury product. It's really messed up that in this country, if you have millions of dollars, you get great advice. There I was in the audience set, I was 24. I had made some money because I worked on the prop desk at Morgan Stanley, and I kept saying, no one wants to talk to me because I'm not wealthy enough to matter, but that's bananas. And I then said, I'm gonna go build the product, started building the product, started writing the content myself. I did TED Talks, and I was building a thesis very publicly. And the funny thing is I had no competitor, which is wild. And so again, it's nice to be an N1 asset where you can do something and people can follow it. And then all of a sudden you become the world's expert at that one thing that no one else is trying to do. That's a pretty good way to build things. And so you can talk to investors without sitting down over coffee.
I love that. It's like harnessing the power of thought leadership and like content marketing, whether that be like you have a newsletter or an investor update of, the mini newsletter. Like there are ways for you to kind of talk one to many here so that investors are aware of your brand and also your thesis. So diving into kind of ways to position yourself, the way we kind of advise founders is like have a really clear understanding, almost like an a priori understanding of like why you are raising, what is this capital going to be used for? Is this the right timing? How are you going to kind of start approaching your first VC meeting, and how are you going to be prepping? So we're going to kind of go through some of these fundamentals, and feel free, as you guys are in various stages of preparing to fundraise or currently fundraising, to stop us and ask questions. So this slide is kind of like the textbook of what a pre-seed seed series A is. Obviously, this is not a perfect descriptor of exactly what every life stage is. We've kind of seen some scope creep. Pre-seed, is now seed is now series A, et cetera, over the last couple of years. But in general, I think there are some universal characteristics, and feel free to chime in, a pre-seed is typically going to be a pre-product stage company. It could be idea on a napkin sketch. It could be a prototype, a beta. The team is really going to be the bulk of how the investors evaluate you. And you might have some individual checks or maybe a friends and family, but not an institutional yet. Seed is usually now where there is some semblance of traction. You have the product, whether that's in a beta form or a wait list. You are starting to add in some institutional investors, and depending on the terms, and if you do have a lead investor, that may either be a priced round or a convertible note or a safe note. Series A is really kind of like the adult, benchmark here is like your product has semblance of a product market fit. You do have a lead investor, and it's going to be a priced round. I'm curious, what are some nuances that you advise founders to kind of think if they say like, I am here to think about raising a series A or a seed? Like what's not being captured here?
Yeah, I think there's a ton that's not captured here. So roughly these are like the right ranges, and roughly, series A can be $6 to $25 million. So it can be huge. But here's the way that I really think about it. Pre-seed is, I've got an idea. It's on a napkin. I probably thought about it a lot. It's probably got 20 slides, or in my case, I wrote a 75-page business plan. Like, here's what I'm gonna build and here's why. You probably have 1 to 3 other people with you in some capacity. You maybe self-funded a little bit to show you really have skin in the game, they're committed. And you have a very clear idea of what you want to build, and you have some reason that you think it can work. So you have customer data, customer interviews, lots of other things. Seed is, I'm past that. I've turned the lights on. I've now started selling something. I have a customer or hundreds or thousands that have said they're interested in what I'm doing. I don't know my go-to-market totally yet, but I'm figuring it out. It's figure out a goal. You actually have probably the main critical roles of the company in place, which is CEO and CTO and somebody on product, et cetera, et cetera. Series A is, I know what I'm doing. I have product market fit. Now I'm scaling past Series A into, I have a go-to-market that I know and I'm perfecting it. And so the difference between A and B is A is I have a really clear sense of my go-to-market. I know my product market fit and I'm gonna go start to scale. By the time you get to a B, you've crushed go-to-market fit and you now know how to scale it to the tune of tens of thousands, millions of dollars, or to the tune of a bazillion customers. And so that's kind of the way that you think about that. And what I would say is if you add revenue to it, pre-seed, it's rare that you have revenue. I mean, or if you do like a fake dollar to round off something. Seed is you actually probably have a few hundred thousands of dollars. Sometimes you'll see a seed where they actually have 1 million of revenue and it's like something is really interestingly working. By Series A, you have anywhere from 750K to 3 million. I'm looking on right now, that is 3.5 million of revenue. And it's Series A. And so it gives you a sense of like, you have a real business, but now it's a matter of like really scaling go to market so that, you know, you're doing in Series B is you have anywhere from 10 to 15 million or more of revenue. And now you're really scaling it. And you're also building the team out, et cetera. Is that a good way to explain it?
Absolutely.
But that for me is how I always ask people, like, how many months up have you been? How many people do you have? How much cash is in your bank account? And how many customers do you have? Because it helps me. Sometimes like a founder may be raising for seed, but they're really a pre-seed, or a founder may be talking about their Series A, but actually they're trending closer to Series B. And so I try to just think about more of what do you know about your business? I don't care what we call it. What do you know about your business?
How do you advise founders who are still in that traction building phase and they're trying to collect design partners, LOIs? Like, how do you convey that, yeah, we may not be at like the 750K ARR yet, but we are trending towards that?
And I think that the best founders are so obsessed with their customer and their problem, and often they are the customer. I was customer number one at LearnBest. I'm customer number one at Inspired. I'm literally building the venture fund that I wish existed for me, so I can show up every day and know how to think about the customer, which is our founders. That's my customer. And I think that the best, to answer your question, the best founders out there, they are so customer obsessed that they're not doing it to check a box. You can always tell that it's like, I did my customer interviews and I got 2 customers and you can talk to them, they're gonna say the right things, versus a founder who is so psychotically obsessed with knowing how to not just make their customer happy, delight their customer to a point where like the customer can't live without the product anymore, whatever the product may be. There's a bit, you can tell the difference. And so sometimes people are like, I did 70 customer interviews and here's what they look like. You know, like you kind of did them so you could tell me you did 70 versus you did them obsessively because you wanted to know what matters. And we always at Inspired fall in love with the entrepreneurs that really understand the difference of noise and what matters. And you can tell because, and by the way, we like things to be hard up front. We actually look for the founders going, I think it's really hard. And we're like, that's great. You don't want something that's really easy because it means 6 people can compete with you tomorrow. We don't want that. We want hard-won insights where you obsessively listen to your customers. Maybe you got 2 things wrong, you get the 3rd thing right because you wouldn't stop paying crazy levels of attention to what they did say, what they didn't say, how they acted, what they didn't do, what they paid, what they were willing to, what they wouldn't pay for. And you have a psychotic mapping of your customer in a way where you really get insights. You know how to get a purple cow. You know what's going to make it a purple cow. And those are far more important. And sometimes I think we live in these like very talkative worlds of being a founder where like you can go on and get a playbook and get 6 stacks and drop your info into it, which doesn't serve you well because playing founder versus being founder is very different. And you want to be founder, not play founder. And I think when I was building companies, there was no content online. Like literally the lead startup, I think came out sometime 3 to 5 years after I started a company. And I was like, God, that would have been super helpful. Like, I could have read that. But now it's like, you kind of know how to play the game versus really win the game. Like you're not just trying to get on the field and kick ball. You're trying to get a goal. And so I just want to make sure I say that sometimes you're only doing yourself a disservice by playing founder versus being the founder who's going to win the game. And so I think that's really an important differentiation. We live in a world of hype and founders bragging about X, Y, and Z. None of that matters if at the end you lose because you played the wrong game. And guess who that hurts? You, the founder, because you've just sacrificed years of your life doing the wrong thing. So do the right thing, which means do the hard thing. Obsess over your customers.
I love that because I do remember like customer obsession being a key part of Instagram early on. And like whenever we would turn off someone's account, you know, for whichever reason, like people would actually show up to the office to be like, look, this is why like I can't live without Instagram. And I feel like that is a level of customer obsession that you have to experience in real time to see. So we have a question, right?
In the chat, so how do you advise companies to find the right number to raise and thinking through the valuation? That would be a good thing for us.
So I'm gonna say something controversial, not to be controversial, but just to actually be the best teammate to founders, which is, I think sometimes founders are like, okay, I really want to get a $20 million valuation or insert whatever number. And I always say, here's what you care about. You care about getting the right partner. How much do you raise was one of the first questions. Look at your actual business plan. And I always say every single CEO has to be a CFO. You have to be. You cannot be like, here's, I can answer that question. Someone have my guy come in that helps me answer these questions. No. Your job is to get in the spreadsheet, to know every single cell. That is the data that drives your company. You have to roll up your sleeves and know what your self goals. And then you have to look at your plan. What is your plan? Take your plan and then double the plan and say to yourself, okay, I think I need $1 million, I really need 2. Or my plan says I need 1.5, okay, so I really need 3. Because everything's harder, everything takes longer, and I'm gonna make entrepreneurship sound so delightful, but I'm obsessed with it. Everything is just that much more painful than you think it will be. And so the number is double what you think it is. Nothing's changed there since when I was building a company 15 years ago. And then the second question is like valuation and dilution and all those questions. Here's the difference, like if you are, I'm gonna use a sports analogy, like if you're trying to be a football player, you want like, Eli Manning on your team, or do you want like some football player that doesn't matter? You want Eli Manning. So it's like, you wanna think about how do I train with the best, the people who are gonna be the most obsessive at helping you get the right decisions. And so for me, it's like the only valuation that truly matters at the end is what did you sell the company for? Or when you went public, what did that look like? Because anything between then and then is just pathways of small amounts of dilution. And again, if you don't get to the end state, then it really doesn't matter if you got the right price that you could share with a friend that wasn't the right path. And so I far prefer founders who are like, here's the number I need. I can raise between 3 to 5. 3 is tight, 5 is preferred, but it's probably somewhere in between there. I really care about not trying to ram out a process and be like, I need decisions by Friday. They're like, I want a great partner. I want a partner that's going to make me train the hardest, that's going to have me out there running laps at midnight to make sure I'm truly the best on the field, that's going to find the blind spot that I didn't see because I've never done this before. And then you want a fair valuation. You want one that is fair to you and your team. But that's probably not the highest. It's definitely not the lowest. It's somewhere in the sense-making realm. And one thing that I don't think founders think enough about is that you need to know whatever the next valuation will be to make sure you can clear it. So let's just pretend you come and raise a seat for me and you're like, I really want to get a $35 million valuation. I'm like, okay, I hear you, but like you currently have 300K of revenue and Series A's right now with 3 million of revenue are getting done at 40. So do you really want to put yourself in a position to really push your price at 35 when right now things are 10x better than you are in terms of revenue getting cleared at 40? Don't do that to yourself. And I have this visual in my head where I'm like, as CEO, do you want to land, if you're a pilot, on an island the size of Greenland or St. Bart's? Greenland, make your life easier. Try to make a valuation that you know you can clear, that if you're like, and again, it's like, because psychology is a big part of business, and I think we forget that. But as an investor, if I find out that your last round was 35 and you're only at 800K revenue, I'm like, oh man, I should stop this call right now because your expectations are to clear 35 and you haven't really cleared it today. And so I don't really even want to talk to you because I don't want to be the one to tell you I can't do your deal. Because I don't want to be the bearer of bad news. So many investors go laptops down and the Zoom walk away because they're like, your last valuation was too high. And so again, I'm telling you what I want you to hear, not necessarily what is like the sexiest, concept to tell you, which is you constantly want to make sure you're giving yourself a fair deal. But by taking the deal that is to the tilt, Right now, I can tell you there are a lot of founders who in 2021, 2022 raised at $1 billion price that they never deserved. And they look back at that, and as those companies are now taking 85% dilution. Let me say that again, 85% dilution. When maybe they had raised at half that, they'd be taking, that's 4 rounds of financing in one dilution. That's 420%. All because they took the price that wasn't the right price. It happens all the time, and so that's why I'm just like, to play long-term greedy. I've always been a long-term greedy entrepreneur and investor, and knock on wood, I've had 2 exits under my belt of things that worked. And so I always say, be long-term greedy. I promise you it's a better financial outcome for you, your team, your customers.
So price is not the hill to die on here.
It's
That's the
never the
takeaway.
hill to die on.
Yeah.
Are you getting the right people in the boat with you to go on a really hard journey? And you want the superstars in the boat that are gonna see the difference between like night goggles and like the storm's already here.
Yeah, yeah. We also have workshop founders who raised at the peak in 2021, and it's like, wow, you raised a Series C without product market fit, and now that's much more painful
And I will tell
experience.
you, those are the most miserable, like, you think fundraising is hard, think about running a company when you have no idea where to go and everyone's stock is gonna be upside down and it's painful. So I like to help founders avoid absolute toxic levels of pain.
That's a great value prop. We actually added this slide because Nico Bonazzo's at one of our fundraising workshop talked about the difference between types of founders, right? So like a seed for a first-time founder versus someone who is well-connected versus, a hot founder with repeat success. I feel like this slide, we put it together to incorporate his feedback, but also to answer a lot of the questions from founders of like, why is so-and-so getting a higher valuation, getting it done just because, they have one like pedigree check mark under.
Yeah.
How do you advise founders to
Yeah.
not compare themselves or to compare?
Yeah, we have an amazing founder in our portfolio. We were the first dollars in. She is just an absolute force of nature, and her first round was a C plus. She also helped take a company public, was president of a publicly traded company, was GM of all of Uber North America, and in her sleep could do in like 1 week what takes a lot of first-time founders, what takes a year. So that makes sense. We also trusted that she would clear the next round with her eyes closed because she knew what to build and how to stay disciplined and ignore the cash in her bank account. So that's the difference. But again, if you're if you're between a C and a C plus, and you've got 2 term sheets, I just want you to remember that if you're a founder who isn't, a Michael Jordan, because you're the first time founder, I was the first time founder. Taking the difference between a C and a C plus, you want to be careful. Like that C plus comes with a higher bar of execution. Think of it as like pole vaulting. You just raise the bar, and now you got to clear a different level, and not clearing it is really painful. And so I always say, land on an island the size of Greenland. Take your plane. That's a big island. So you can almost have your eyes closed, you're like, we're gonna land. Versus in park where you gotta come in with a left angle, and then sometimes they turn back around because they can't land. Make your life easier. And so remember, keeping the bar up and to the right. I'm also I'm not telling you don't raise capital. Just make sure you raise it in a way where you can clear the next round and have a real plan to do that. And not a plan that you can explain to somebody, a plan you can explain to yourself. Because you're going to be the only one. And I'll tell you when things get bad, what happens, investors run away. And then who's left? Just you. So I want you to have answers for yourself on why you think you can clear it. And better
By clearing the next round, because it's not just about raising the highest possible valuation, but how does this set you up for your C plus, your Series A? Yeah.
And what you don't want to do is an early down round where you get 50 to 80% dilution, which is literally the equivalent of 2 to 3 fundraisers, because you simply took the difference between a C and a C plus. You know what I mean? So you're be long-term greedy, get it right. I own a lot of the company at the end because you just kept taking times And remember, as founders, we can also ask for more equity later. We love to give our founders more equity. We're like, you're kicking ass. I want you to own more of this company. Because I want you all in and I want you to be here for 15 years kicking ass. That's the sort of investor we are. We're like, can I give you more equity of your own business? Because I want you super motivated long term. So again, go ahead.
Another question from the chat, how do you know you're choosing the right VC to work with beyond just like taking a check? Like what are things that you can look for?
I would do a lot of references. I would ask them for references and then I would go do off-book references. We always say, go talk to all of our founders, call as many as you want. Go back channel, go down the list, call anyone you want. And ask them, like, did we show up? Did we matter? Did we help? Did we make a difference? Did we make a material difference when things mattered? And so I would just do those. And I actually think it's really important to also take phone calls with founders where things aren't going well. Where it's like a founder who had a down round, like, how do they behave? That's all that matters in life is reputation. And none of us are perfect, but you want people that have like near perfect reputations because they always do the right thing for the founder. And so I think it's really important that even if you only have one term sheet, go do the references, do all of them.
How do you get in front of those founders? Excuse me, how do you get out of founders, get in front of the VCs?
Are you talking more about like investor?
Introductions to VCs. I mean,
Oh, how do you get to the VCs?
how do you get to VCs? What do you find to be the most successful approach?
We actually have a slide for that, so I'm just gonna.
I don't really like that pick the right time to raise. But you go back real fast.
Oh, yeah, yeah.
Just calendar thing.
Yes, picking the right time.
I just want to see what you guys say. Okay, so I have one big edit to this slide.
Okay.
I have there are 3 months to raise. Only 3.
Only 3. Oh,
January, April, and September.
wow.
April, September.
Okay.
Investors come back with a force of nature. It is after the holidays, January, I gotta go do my best work. They come back after March and spring break, I gotta do my best work in April. And then I come back after August and they gotta do their best work in September. And since fundraising takes about 6 to 4 months, if you start in January, you're getting it done. But if you start in some of the other months that I said I wouldn't start in, you can end up in those off months. You see the big X's, I would add, the end of half of November because of Thanksgiving is a bit of an X. March is an X because of spring break. Most investors have kids. And so they are sort of, kids are distractions and so I think it's January, April, September.
Yeah.
Can I say something? I have
Yes.
a partner and he's always asking me, why you always follow up the, school, schedule over the year? I say, because everybody busy with children, you cannot find anybody in July, August, because then it's the family is getting ready for September, they buying supplies. It's always, the family values first, and then the business.
Yeah, and it's also just remember, these partnerships are teams of humans that have to sit in a room all together and make a partner meeting decision because we have an investment committee. And so the problem is kids have different schedules in March. And so some investors are out this week and some are that week. And so you can't even pull together a partner meeting. So I remember so clearly, you don't want founders to be in a position where they're in February trying to get to partner meetings, but then it's like, well, we can't schedule one, so let's move you to April, and now you've lost all of your mojo and all of your momentum. And so, yeah, January, April, September.
Be for the types of investment committees where partners can do single partner deals.
Yes, if it's, those are very rare. They're rare, and I don't know that I always know who that is.
True. Yeah.
For the most part, your better and best firms in the country have investment teams that go to full committee, underwrite things, and follow a really tight process because that is the product we sell our LPs. So, okay, that was just, I wanted to say that because I was gonna say that anyways, but the fact that you had a slide, I could say, no, January, April, September.
You guys heard it.
If
Those
you
are
kick
the
it off
that
on
matter.
31, January is literally January 2nd. September, day after Labor Day. April Fools, let's go.
Love that. The 3 months to live by as a founder. I just wanted to flip back to, I think the one I was looking for was how not all intros are equal here. Do we have that? Yes, to answer your question and just like how to get in front of a VC, we have here a spectrum of everything from like the cold intros of like sliding into someone's DM, sending them, an email campaign, to kind of the stronger social currency signals of like having an existing, partner to that VC, whether that be, an attorney, bankers like us, or the strongest one, which I think is kind of the ninja move here, is like having a portfolio company of Inspired being like, hey, Alexa, we gotta get this founder in front of you.
Literally the intros that like I take in a millisecond are when our founder introduces us to somebody. I like,
They're taking their reputation, right?
and like you're an important partner in their life, and they're saying this is somebody that you should meet, and they know what we look for. That's like a layup. So I would like triple circles the founders, and find a way to get to those founders, get to know them, ask them, hey, I would love to meet with Inspired. Here's my company. What do you think?
What do you think about cold intros? Have you like seen any successful cold intros? Has someone ever emailed you?
I took one in a way that actually was a founder who wrote a really thoughtful email to me and said, I saw you invested in this company, this company, this company, and here's a reason why I think you were, and so it was not a, hi, here's my company, here's my deck, it's completely, I could delete because like you sent it to 72 other people. And I was just like, this person's scrapping, and I immediately wrote back and was like, how about tomorrow morning? So we met this morning, and then I was like, I reward scrappiness and hard work and effort, and that was a great email.
What about that email kind of hooked you in? Were they like commenting, critiquing?
Human beings.
Yeah,
I mean, I want the founders that do, I would say, like, I don't want the person who gives 100%, I want the person who gives 150%. And that's what I'm looking for every day. On every decision, you're just doing the extra mile. Life happens in the extra mile. Doesn't happen at the finish line. It's the extra mile. And so I'm just constantly looking for people who that is their standards for themselves. How they put in effort, how they put in work, and you can tell because it's the extra mile. It's the not lazy answer, it's the hard answer. And I always say in life, you're not looking for an answer, you're looking for the answer, the right answer to problems. Not an answer, the answer. Which means you have to do more work, you have to think more, it hurts, your brain hurts, because you have to think more. And those are the people that we want to work with, because they're gonna get better answers.
honestly, I feel like I'm sitting next to Oprah right now. This is so inspiring. Yes, we've got an answer in the back, a question in that.
For the answer to the question, I've got a question about materials and seed and pre-seeds, and not giving sort of false precision on forecasting. I mean, this is before where I've followed your modeling all the time. I don't want to risk doing that. So if it's team-led decision at that early stage, how much time and resources should be into modeling and forecasting when frankly it's a finger in the air regardless?
So
What mind repeating?
yeah, his question was like, when it's early, when it's really pre-seed and seed, by Series A, you should have some real modeling.
Yeah.
But pre-seed and seed, you're kind of making stuff up, right? You're like, I don't know, I think I can sell this many people, this many things. But here's the difference. That model is not being made up. It's not. It's very thoughtful assumptions of what you believe is possible and why you believe they are possible. So it's more about the quality of the thinking than it is the results. And so I think what's really important, and we like to double click, we say, tell me your assumptions. Let's walk through them. Why do you think them? And we'll debate them with you. We'll push you and say, okay, you think you can close a customer in 75 days. Okay, but your last 3 customers you closed in 200 days. So why do we think 75 is the new normal? How'd you get there? And like, that is a level of thinking. And so I actually what I think is better is to have really, really detailed assumptions pulled out. Like, here's my model, but here's my driving 5 assumptions that I have to hit. That's really what you're hitting, the assumptions. The numbers kind of fall after that, but what are the assumptions? What are you selling your product for? How much effort does it take to get there? What are your margins? How much did it cost to sell that product? Those are the assumptions that matter. And yet, by the time you're at Series A, you really have, it's real. So we're like, gonna double click into every single detail, every single cell, and understand how you're thinking about it. What else? Go ahead. Go ahead.
I just want to go back to that point that you were talking about with being obsessed with your customer. That's kind of my role as the CEO of a very technical company. I'm on the business side, my co-founders building the tech. My job is just to talk to the customer, the potential customer, all the time about what they need actually. And what that's done is it's made us actually move really far from where we started. We've gone on this like windy road, and we're no longer in the space that we were initially like quote unquote experts in, focused in. And I love, because it's been this incredible challenge of like building something that we're being told to build. But I can also see a side where people can say, oh, like you've left your domain expertise. And again, I'm a first time founder, a younger founder. I'm already not in that space. And I'm just wondering if you can speak to balancing being obsessed with what you're hearing the demand for and remaining like poised in yourself as a founder and an expert in what you're building, if that makes sense.
Yeah, your question is, how do you adapt to feedback from the market, right? You have a point of view and a conviction of, I think this is what is gonna work. And as you listen to your customer, you also don't wanna be like, okay, now I'm gonna run to the right, now I'm gonna run to the left. Am I?
Yeah, or like, and if you do find something that is actually is the thing, like, which I believe is what we've been able to do, but it's far from where you initially started, how to kind of navigate that.
Yeah, I mean, I think that remember, in some ways you're like a scientist when you're really starting a company, which is you have a hypothesis or a series of small hypotheses, and you're trying to quickly test to get a sense of, is this right? And I think one of the things, again, that is the worst thing you can do to yourself is like, tell yourself false data. I think the more important thing to do is like, make it hard. Like, you know, if you have customers, did you give your product away too much? At some point, are those customers, or did you just, are they getting free shit? It's a free shit sale. You want real customers. And so to your answer, like remove those boundaries at some point and say, well, I'm not selling this. It's going to cost you $20,000 a month if it's enterprise software or something like that, or it's going to cost you $89 a month to stay subscribed and see what happens. So like you can test those also in small ways, right? Remember, it's not like a valve where overnight you charge everybody. Like one by each, you can say, hey, this cohort, we're gonna start charging. And if they all run away, then you kind of know the product's not good enough yet. So like you're a scientist, and I do think like a very thoughtful Socratic method to solving and understanding customers is important. And then the other thing is I used to read customer feedback every single night for almost all 7 years of being a CEO of the business. I would read snippets of the feedback. At some point, you'd be millions of customers, so I couldn't read everybody. But I would read snippets because I would be like, oh, I'm obsessed with this. And I'd be like, okay, they're still obsessed with it. It's like 40 of the feedbacks are obsessed with it. Or like, this is not great. I really am pissed off about this. You gotta be obsessed with the feedback. And it was good. One eye open, I was like going to sleep and I'd be reading feedback. And I think founders that have the chance of winning do that. Good.
Yeah, so I'm a founder of a health tech startup, right? And we're pre-seed. But many things I'm obsessed with. One of them is this getting our go-to-market strategy, nailing it down. So we're investing a lot of time and effort on that. What are your thoughts on that? Because I'm hearing that maybe you can wait till later.
On nailing down your go-to-market strategy.
Yeah.
Well, I think the other thing about a go-to-market strategy, sometimes I think we overcomplicate it. It's how are you gonna get customers? That's all it is. It's how do you get, all it does is how do you get customers and in what way? And so I think what's really valuable about that is when you found the company and it's a piece of paper, just you should have a strategy on that. And so I'm not saying wait until you're A or you're B for it. I want you to have a really good hypothesis and then start testing it as you go. But so there's founder market fit, that's pre-seed, and there's seed, which is like beginning of product market fit. By A, you have product market fit, like the product works and people like it, but then it's go to market fit, where you figure out your best way to go sell your product. I want you to have a hypothesis for all four up front, but you're refining. And someone said to me, like, you're like chiseling the David. It's like chisel. You're not coming in with like, huge sledgehammer sometimes. You're just constantly refining. But can I tell you one amazing tip on go-to-market? One of my friends would email the CEO of like company, literally the CEO, and be like, hey, I met you at that event and it was amazing. You were gonna connect me to your head of sales, like here's my deck again, here's me. And CEOs will just forward it. And it's like such a smart go-to-market strategy, because if you can like write thoughtful enough emails, they're so busy, they'll just forward it down. And I was like, that's genius. But so like, and that's not gonna work for everybody. But like, you get my point where you're just like figuring out every hack to get to the people, and in short distances, and figuring out why your value prop is strong enough that someone will get off another product and on to yours, or add a new product to their suite, et cetera.
And it's driven by, we raised some money already, but before I raise more money, I want to be confident that we will be successful in the marketplace.
Yeah.
I want to be fair to my listeners.
I hear you.
We have time for one more question, so Ben, go ahead.
6 to 24 months, is it necessarily a good signal to raise quickly, and like what other factors influence the timeline?
Raising quickly, so like if you, let's say you have 2 months, 2 years left of runway and somebody preempts your round and you decide with that preempted term sheet to take one more meeting, that's sort of plausible. If you really have 24 months and things are working, like my skeptical question would be, why not wait? Like, why not wait another year? I have a rule of thumb, which is you should always raise with at least 8 months of cash in your bank account, and probably in this environment closer to 12. So you really need to raise when you have 12 months left, because you don't want to be even close to needing the capital, because people just smell. If you like, I have 3 months left, it's like that's
Very dire times.
that's not planning. They're like, oh, well, I don't want to give you any money because why do you plan that? And so, but like, if you have like 36 months left and you're raising, it's sort of like, either you're truly, there's a reason where like your company is working so well that you should take the $50 million round and go swallow the entire market because you are crushing it. That makes sense. But other than that, it's like, well, then why not just go execute and wait till you have roughly, 16 to 12 months left and then raise your next round at probably, if you're crushing it, a much better valuation. So it's, again, those are the kind of bands. This has been an absolute pleasure, everybody, and hopefully this was valuable and helpful.
No, we could go on for hours with you, Alexa. You have so many gems. So just to kind of close things out, I do want to end on our Nexus tool, which is an invitation-only investor connectivity platform that we built for SVB clients. So you'll be able to, if you're currently fundraising, it's an application basis. So if you do get in, you'll be able to get in front of VCs like Alexa and others. We bank. This is really a way for us to kind of scale our investor connections beyond just one-to-one connection at SVB. So feel free to come up and ask any questions if you are interested. But thank you so much, Alexa, for all your nuggets of wisdoms and gems. And like, what is the best way for us to kind of continue, reading, learning more about Inspired? Where are places on the internet for founders to reach out?
You can find me anywhere on the internet. I'm just Alexa von Tobel.
There's no LinkedIn. I'm waiting for you.
You can find me on LinkedIn, you can find me anywhere. I have a podcast, Inc. Best Company, which I interviewed literally your best founders in the world. I'm going into season 7. I've been interviewing your best entrepreneurs on the planet and like study them, who they are and how they got there. So that's good content. And then you can email me, and it's very easy to find. And so just thank you guys so much. I really appreciate it. And again, I love building businesses with amazing human beings. So thank you all for being those people.
Thank you.
Party in SF, they have one question.
yeah.
Is it okay if we do that? Okay.
Absolutely.
Thank
SF,
you.
off mute.
Can you guys hear me okay?
Yes, we can hear you.
Oh, hi. Hi, Alexa. Hi. It was a fantastic presentation, so thanks for that. I have a question on one slide, which talks about pre-seed, seed, and seed A. Here you're talking about pre-seed when the product is not even ready, and the seed when it is ready and everything. Now, can it be in between? For example, in my case, I have developed a product and there are paying customers. So am I a pre-seed or a seed guy? I don't have any funding options at the moment. So how do I characterize myself?
Well, so you said you have the product built and you have customers that are paying you.
Exactly correct.
And you don't have to share with us your revenue, but I would say if you have tens of thousands of revenue per month, you're probably a seed company. If you have 100K or more a month, you're probably closer to a Series A company. And remember, these are really good rules of thumb. One thing I would say is like, if you're a biotech company, you probably have to raise like a full huge sheet up front because you're like, I need money for labs and like, you know, rats to and other things.
Yeah, this.
You know, there's,
Wait,
so
studies.
correct, I'm roughly talking like typical venture bets. But every company categories have slight nuances, so I would just say, I think you're probably a seed company, is my guess. Maybe a big seed company, but you're probably a seed company.
Oh, thanks, Alexa. Thanks.
Cool. And thank you, Asa, I appreciate it. So,
Yeah, we got a over 20-person watch party.
cool, thank you guys so much.
Thank you all.
Thank you, everybody. Thank you.
Thank you.